Let's talk about the way the markets are setting up, because it feels like there is a new affinity for risk in the marketplace. Is it justified?
Well, we do think it is. A lot of it has come down to, I think, a resetting of earnings expectations, which is really what we went through in the fourth quarter of last year. I mean, quite negative earnings revisions, primarily in the energy sector and, of course, in technology. And I think the market prices reflected that. We're starting to see it turn around, however. Of course, we have oil prices moving up again, so that should help earnings outlook there. We're also starting to see positive earnings revisions again within technology. So I think that's one of the key things that's supporting the market. But of course, the other half of this is the Fed, is a more patient outlook and dovishness, and we'll see whether or not we get that confirmed after the meetings this week.
Over the past few weeks, we've seen a renewed focus on inflation, consumer prices, prices at the wholesale level, also with regard to energy, like you said. All of that is playing into interest rates, but in an odd way. Why is it that with all of this talk of perhaps prices rising more, we still see Treasury yields hovering at some really, really depressed levels?
Well, you need to separate a couple of things. There's inflation expectations, there's what's actually happening with inflation, and then there's real yields. We've had, generally speaking, disappointing inflation prints, which is why we think the Fed is unlikely to raise rates at all this year, which certainly the markets quite like. At the same time, inflation expectations are going up in line with oil, and we think that's a big part of what's supporting the equity markets. At the same time, you have real yields falling, which explains why nominal Treasury yields remain low. So you've got kind of things going in opposite directions, inflation expectations rising. Good for equities, real yields lower. That's a bit more ambivalent, but I think it at least explains why you have this environment where you have rising equity prices but very low bond yields, which some people see as a contradiction, but we actually think it's consistent.
To what extent are those lower yields also driven by the fact that we are seeing some of those yields in the European Union anchored so low as well?
Well, there's always the question of which market leads the other. I think we're seeing the ECB and the Bank of Japan, for that matter, really kind of following the lead of the Fed. And if we think about the concerns that we had earlier last year, which was the scenario of balance sheet runoff and hikes from the Fed, and then that pushing the ECB and then the Bank of Japan in their own way to raise rates, that's all pretty much now reversed. So the ECB is more dovish. They've pushed out their hike into 2020, but I think they're able to do that because of what the Fed has done. So I think really the Fed, as it tends to do, is really leading global interest rates, and that's giving the ECB the opportunity to leave rates lower in the hope, kind of this long-standing hope, that finally you see a bigger acceleration in Eurozone growth, which we think we actually will see.